Hello option traders, and thank you for choosing Money Alpha. In this video, we're gonna go over what's like being a call option buyer, call option seller. We're gonna talk about the risk profile. What is the risk profile? The risk profile is a tool provided by our broker to help us understand our position better. Do all brokers provide a risk profile? Yes and no, generally speaking. If you can understand one risk profile, then you can read and navigate through other risk profiles. So let's begin this video. Right now, we're on a ticker called Amazon, right? To keep it aligned with the hypothetical example provided in this section. And I'm going to go to the 15 December 2023, 16 days of expiration. I'm going to go for the 150 strike price. If you don't know what's going on, then I highly recommend you watch the video where we break down the option chain and explain things for you. However, I'm just going to do a quick refresher here today. This is the strike price, this is the puts, and this is how much each option contract on the put side costs. Similarly here, this is the calls, and this is how much each call option contract costs. So if you want to read the 149, how much does it cost? It's around $200. I'm rounding it. On the put side, the 149 strike price cost around $400. I'm rounding it. The reason why we're saying 400, not $4, is because we times them by 100. Okay? So last time I left you guys was right here between buying and selling. You had an option to become a call option buyer, call option seller. You notice this small white box changes. I'm going to start off by being a buyer, and then we're going to talk about being a seller. So what does this position mean? Let me explain it real quick. I am a call option buyer. I am paying $175 to the seller for the option to buy 100 shares of Amazon at the 150 strike price and the 15 December 2023 expiration, or in the coming 16 days. And 175 is the cost of one option contract. I'm going to repeat it one more time real quick. Me, the call option buyer, is paying 175 for the option or the right, whatever word works for you. So me, the call option buyer, is paying 175 for the option to buy 100 shares of Amazon at the 150 strike price in the coming 16 days. Okay? Currently, Amazon is at 146.75. And my strike price is 150. What does that mean? I want Amazon to go up as fast as possible. So a question that might come up is, how does this transaction work? What happens behind the scene? Like, I'm paying the 175 to the seller. How does the seller take it? I'd like to know, how does it work, please? I'd be like, okay, I can explain it for you. So you are right now paying 175 for an option contract. You're paying for the call option contract, this contract right here. Okay? This is what you're paying for. Once you tell your broker, hey, I'm interested, so you click confirm and send, and you send the order, pretty much telling your broker, hey, I'm interested in buying this contract for 175. Your broker will take that option contract and take it somewhere called the order book. What is the order book? It's a digital order book where all the transaction of the stock market happen. Buying and selling calls, buying and selling puts, stocks, everything, all transactions happen in this order book right here. So what does the broker do in this order book? It looks for somebody that wants to be the seller. Somebody, instead of who he or she clicked buy, they clicked on the sell. They're looking for somebody exactly interested in the Amazon ticker and the 15 December 2023 and the 150 strike price on the calls. Okay? Somebody who wants this deal and wants to become the seller of it. So after it goes through the order book, it does a quick technical search for it. They find a seller eventually. And that seller, done, we found them. So this is the option seller. Once the option seller been found, the option seller takes in that money, and this is you right here. Beautiful smile looking. What a gorgeous smile. Takes in that option contract. Sounds good? And this transaction happened in a matter of seconds, all this. And usually the broker will charge you around 170 $7, I would say. They take $2 commission and fees for doing all of this stuff. So that's how they make their money. Okay. Now, a question I might ask, well, you might say, well, you're telling me what the broker does, it looks for somebody who wants exactly this position, and he wants exactly 175, and he wants to be the seller. It seems like I'm never going to find somebody. I'd be like, that's a good argument because the odds of it, like specifically this one, but like, there's a way to actually find out if you're going to have a high chance or a low chance of fixing it, and what is the way to fix it if it's possible to fix. So this issue we call is liquidity. When something is liquid, that means the transaction is done quickly. Something is not liquid, that means there's not a lot of people buying and selling it. That means it's not liquid, right? So the way to know if a option contract is liquid is look on the bid and the ask. If you notice the bid and the ask is $2 away, $1 away, that means there's a lot of people buying it and selling it. That means your order is going to get filled within seconds, right? You'll find a seller. But when I say your order get filled within seconds, that means you will find a seller within seconds. And if you look at this option strike price right here, the 142 call, this is around like $15 wide. What does that mean? That's probably going to take you a couple minutes for your order to get filled. I have seen bid and ask with a width. By the width, I mean the gap between the bid and the ask, around $100, $200. Whenever you see those, you want to avoid them. Why? I'll tell you why. So let's say you want this order, the 150 call, and you send it for 175. Nobody takes in your order. How do I fix that? You simply increase it $5. So you're pretty much giving $5 extra of the market price just for somebody to take in your deal. Sometimes you don't even have to increase $5. You can just need to increase $2 or $1, right? Just simply you doing that, you make your deal more appetizing because, oh, I'm giving extra $4 $3 for just somebody take the deal. With an option seller, he'll look at it and he'll see, oh, I'm getting extra couple dollars to take that deal. Done. Your order will be filled within seconds. Right? So when you have a very wide bid and ask spread, what you're going to do is you're going to have to pay a lot of extra money just your order to get filled. Like unnecessary amount of money. You're overvaluing that option contract. So that's what I say. If you ever see a bid and the ask that's very wide, my advice for you is don't trade it. Find a different option contract. Maybe change the ticker. Look for a different ticker in the same industry. And what is a very wide bid and ask? I would say anything above $50, $60. That's not good. And this issue with a bid and the ask being very wide, like 60 and above dollars, usually happens with uncommon tickers, right? Tickers you're never heard of before. Usually happens with penny stocks. So generally, it's not a very big issue with the stocks, like Apple, Amazon, Tesla. These are pretty liquid. There's a lot of people know them. A lot of people buy and sell them. Okay? So now that you understand how this transaction works and you know it happens in a matter of seconds, let's go to the risk profile to break down our position. So I just simply click on the risk profile and this is the chart. Now I know you're looking at the screen and you think this chart looks scary, but I promise you it's nice and friendly. I'm going to break things down for you to see everything you need to know. So on the horizontal line or the x-axis, this is the stock price. Okay? And on the vertical side, this is all wins and losses. Anything above zero is, as we took in our math classes, is a positive, and anything below zero is a negative. So this is negative y-axis or negative vertical line, and this is a positive vertical line. So this is plus $500, plus $1,000, plus $1,500. This is all profit right here. Anything above the zero is profit. And anything below the zero is a loss. So this is negative $500. This is negative $1,000, and so on. You might notice that this zero line right here have some red intersections. What are these red intersections? These red intersections is an indication of our break even. So you'll start making money after the 151.75, and here we'll start making money, I would say, after, let's see, 146.65, I would say. You'll start making money after that line. So you might ask me, why is there two lines? And why is my break even 151.73, not the strike price of 150? So I'm going to explain why is your break even 151.73 rather than 150. When you are buying this 150 strike price, you're also paying the 175. You want to make your money back as well. So your break even is the strike price, the amount that you paid, plus equals this break even, the 151.75. I know it says 73 is because I manually input it, and sometimes these are sensitive and hard to put the line in the sand. So just let's say it's 151.75. Okay. So I have a question for you. If you paid $200 for this option contract, and that's a very good looking too. Let me redo it real quick. So you pay $200 for the 150 strike price. How much would you say your break even would be? If you said 152, that's correct. Because remember, you want to make your money back that you're already paying for. So let's get rid of all this, and let's go explain why is there two lines, a purple line and a blue line. Simply go look on the left bottom corner right here. The blue line is your position at expiration, and the purple line is your position in today's current date. So that means if Amazon moved today to the 149 strike price, right? You want to know how much money you're making. Simply, you go read it. If today it moved at 149, you're making around some amount of money. But I'll show you the details in a bit. And if you want to know if Amazon went to the 149, but it stayed there until expiration, right? You're losing this amount of money. Now let's go find out how to know what is the exact amount of money. You just take your mouse and put it over it. Notice on the left bottom corner, it reads it for you. So if Amazon in today's date, like by today, went to the 149, you're making $103. If it stayed there until expiration, you're losing $175. You might ask yourself, why is that? Option contracts lose value as time passes. So as time passes, this purple line merges with the blue line. And I'm going to prove this claim right here. I'm going to go to the 8th December 2023, and I'm going to buy the 150 call. And you just notice, I'm going to round it down to $100. Just simple, a 7-day difference. It's still the same, it did not move much, right? Just 7 days difference, and it's $75 difference. You see, so as time passes, option contract loses value. So, and the risk profile already calculates that for you. It tells you and lets you know that if you want to make your money by expiration, you want Amazon to start trading above your break even by expiration. If Amazon stopped moving in today or tomorrow, I would say you're making around 138, dollars. So once you make that amount of money, my advice for you, if you're not planning to hold that position, exit. Why? Because of two things. Number one, option contracts are time sensitive. Time is against the option contract buyer. When somebody buys an option contract, he's against time. Time is against him. Number two, it's directional sensitive. When you're buying a call option, so this is a buyer, right? When you're buying a call option, time is against you and direction is against you. So you want the direction to move in your favor. Now, why do you want the direction to move in your favor? Because look at the chart. The more Amazon goes up, look how much money. It's unlimited. That line, it keeps going upwards. It doesn't stop. Your potential profit as a call option buyer is unlimited. And your loss is, can you guess your loss, by the way, before I show it? Your loss is the amount of money you paid. So when you're an option buyer, your maximum profit is infinite, and your maximum loss is the amount of money you paid. It's $175. Sounds good? Now let's take this position to the chart and show you how it looks like on the market. I'm going to do something like this real quick, and let's go look at the chart. So this is the 151.75 strike price. We just drew that line doing that steps. And if you're looking at the chart and it's a bit confusing to you, what are these vertical red lines? These vertical red lines are our expiration dates. You can turn them on and off in the settings. I have them on since I'm an option trader. So this is 12/15/2023, this is 11/17/2023, and so on. And if you notice, these are all main expiration cycles. And that's the reason why I chose it today, so I can show you guys in this red line. So I'm going to zoom in a bit right here. And I'm going to do this. So on the bottom, these are all dates, right? And on the side, this is all the stock price. So you, as a call option buyer, this is what you want the stock to behave. Your best and your favorite outcome is just for the stock to go shoots up as fast as possible. The further it shoots up and the shortest time, this is the best outcome for you, right? To do something like this. The worst outcome for you is Amazon never sees you again and just goes down. And this is our expiration date, by the way. And never sees you again. Or even doing something like this, a small downwards is very bad. You, as the call option buyer, your second or your optimal outcome is for Amazon to do something like this and just stays around that range. This is considered good for you. And my advice for you is, as a call option buyer, if you ever make any money, any profit, and you like that profit, exit. Don't hold it unless you have your own opinion, you have your own belief that it will go up further, and so be it. But my advice for you is, once you make your money as a call option buyer, exit, because time is always against you. And also direction. If Amazon does something like this and just wiggles around, right, and stays around that area, you'll make money at the start, but if you continue holding it until expiration, you're losing money. Now let's go take a look of what's like being a call option seller. I'm going to simply exit this position. I'm going to click X. Instead of clicking on the buy, I'm going to click on the sell. And I'm going to explain this position for you. So you are the call option seller. What is happening to the call option seller? The call option seller is getting a credit of $175. He takes that money, he puts it in his pocket. What is that money for? That money for is if the option buyer decides to execute his right of 100 shares of Amazon at the 150 strike price, right? I have to provide those shares for him, the option seller. And how do I provide those shares? I go buy it at the market price. So let's say Amazon right now is at 155, right? I have to go buy it, me as the option seller, buy it at 155 and sell it to the option buyer for 150, which is the strike price we agreed on right here. Okay, that's if he decides to execute his right. Let's go to the risk profile and see how does our position look like. If you notice, the risk profile is the opposite of the option buyer. The option buyer used to be something like this, along the line like this, and then something like this. So something that might caught your eye is the max profit. The max profit is limited. Your max profit is the amount of money you're getting in, which is 175. You'll never make more than that. Your max loss, however, is infinite, right? You're like, whoa, what's going on? It seems like me being a call option buyer, I have unlimited profit and my max loss is defined. Being a call option seller is my profits are limited and my max loss is unlimited. Sounds being a call option buyer as a better deal. I'm going to give you this advice. In the stock market, there is never, never, never free lunch. That means if the stock market took away something from you, it's giving you something else. And if it's giving you something else, that means it's taking away something from you. That call option buying might be looks like more profitable but the odds are against him. Why? Let me explain. When you're the call option seller, time is on your favor. Time is with you. You're not time sensitive. Number two, you're not directional sensitive. Why? Let me explain that. When you're a call option seller, you're pretty much putting your line in the sand. You're saying 151.75. Amazon, do whatever you want. In the coming 16 days, just don't touch that line. Pretty much telling Amazon, this is your wiggle room right here. You can do whatever you want right here. Up, down, roller coasters, you name them. Just don't touch this line right here. Sounds good? So when you're a call option seller, time is on your favor and direction is already on your favor. Like, look at this. Amazon is currently already in our favor. So if Amazon stays in this position until expiration, we're making $175, right? So let's take a look. How does this position look like in the chart? I'm going to do this step real quick. You can close your eyes, but it just makes that line easier. Back at it to the chart again. This is at the 151.75, right? So how do we want Amazon to behave as call option sellers? As call option sellers, we want Amazon to do something like this. This is our best optimal outcome. Bam. Never see us again. Gone. Did you notice that our best optimal outcome is the worst outcome for the call option buyer? So we're pretty much competing with each other. And if Amazon did something like this, by expiration, bam, making money. Amazon went up and swam around here, still making money. Amazon breaks this line, swims here. Since time is our favor, we can hold. And then it goes back down, you're making money. Your worst outcome as a call option seller if Amazon does something like this. It goes up and never sees you again. Okay? Now you might ask, well, hold on. If Amazon did something like this, does that mean my losses are infinite? I'll tell you, and you will learn that in the coming section, that you can exit your positions at any time. Whether you're a call option buyer, whether you're a call option seller, you can buy back your option, or you can sell or exit your option. Buyback also means exit. There's a section for that. They'll explain that in details for you. But for now, even if Amazon went all the way up to the red line and you saw it coming and you want to protect yourself, you can exit that position so you can protect more losses. So this is the difference between buying and selling call options. Before I do, I just want to exit on something. I have a question for you based on the chart. And this chart goes all the way back to December 16, 2022, right? I'm going to explain to you real quick, why is the odds on the option seller? Did Amazon ever reach in the past 1 year the 151.73 mark? Did Amazon ever touch this line right here in the past year? If you said no, the answer is correct. Based on the historic data that we know from Amazon, in the past year, it has never reached 151.75. Am I saying it's going to reach that break even? I don't know. That's the future. I cannot predict the future. But I'm saying according to historic data, it has never reached that line. So this is why I say the odds are on the option seller's favor. Because even if Amazon stayed in that same range, he can go and buy back that 150 and he'll make $75. That's me being the option seller. If Amazon stayed in that range, right, and until next week, you'll make around $75. That's if Amazon, again, stayed in the same 146, the same price. So the risk profile is a very nice tool that predicts all of that for us, right? Tells us, hey, if Amazon goes up to 150, look at the left bottom corner. We're losing this amount of money. If Amazon breaks and goes crazy, this is how much you're losing. If Amazon shoots down, this is how much you're making by expiration, and if you decide to hold a position. So that's it for this video. I hope you guys learned something new today. And my question for you is, would you rather be a call option buyer or a call option seller? That's something for you to decide. I give you all the information. The decision is yours to make. If you watch this video and you still don't understand what's going on, my advice for you, always tell my customers, is to watch this video one more time or twice, and sometimes that will clear the things. However, if you watch this video once or twice, then send us an email about any questions or any hesitations. We're more than happy to clear things for you. And if you feel like you needed a one-on-one Zoom session, then I would recommend create a 1 week free account. You can take advantage of that. Create that account. That's 1 week for free. Get that one-on-one Zoom session. And if you like it, you can stay. If you don't, you can leave. And one last thing. If any of this, all of this confusing, you want to trade, but you don't want to deal with the headaches of learning and unlearning and all that stuff, I'll recommend just sign up and learn how to use our semi-automated system, and it takes care of everything else for you. It does the heavy lifting for you. You don't need to learn that much. You don't need to know the details. You just need to know to navigate some things, and that's about it. If that's something interests you, go ahead, sign up, and we're more than happy to help you. Other than that, have a beautiful rest of your day and take care.